Hello. In this video, you'll learn about the second step in the 9-step accounting cycle, recording the business transactions in the general journal. We'll talk about how to record Eli's consulting business transactions in the general journal. We'll learn about proper documentation and the audit trail. We'll start off by recording transactions with one debit and one credit, but then learn later about compound entries, journal entries with more than 2 lines. Regardless of how many lines the journal entry has, and some have hundreds of lines, it has to balance, which means the total of all debits have to equal the total of all credits. After the accountant completes the analysis of the business transaction, they are ready to enter the business transaction in the general journal. In most businesses, even small ones, journal entries are entered into an Excel template so that they can be electronically routed for approval and then uploaded or keyed into the accounting software program. Not that long ago, believe it or not, accountants literally wrote the journal entries in a journal ledger, and this image below shows what the ledger book looked like. Although that seems quite antiquated, you can still buy accounting journal books and ledger paper on Amazon and accounting supply stores. Some accounting students even find that it's helpful to write journal entries into a book or on a journal paper when learning accounting. So what is the general journal or journal entry? The general journal lists transactions in chronological order, that is, in the order in which they occur. The journal is sometimes called the record of original entry because it's where transactions are first entered in the accounting records. There are different types of journals, but our focus will be on the general journal. So now let's look at one of those Excel templates that I just mentioned. Here's an example of what a journal entry Excel workbook might look like. The top section needs to be filled in by the preparer of the journal entry first. The preparer enters their name and selects the entry type from the drop-down list, one-time, reversing, recurring, or error correction. Your company could have different types of entries. However, auditors often want to be able to see monthly recurring entries separate from one-time or error corrections. Why? Well, auditors want to ensure that non-routine entries were properly approved by the correct level of authority within the accounting organization to ensure that the department has good controls and separation of duties. Next, enter the date and the journal ID, as well as the entry summary, which is a short sentence about why the transaction is being recorded. Then the journal entry is entered into the line items. And there is a double check in the template that lets you know that the entry is balanced, meaning the debits equal the credits. If they don't balance, this field right here will say not balanced and appear in red. And once the journal entry has been completed, the preparer would send it to the reviewer. And once the reviewer approves and enters their name and the date of the approval, the entry can be posted to the general ledger. This template shows a journal entry with only 2 lines. Many accountants record journal entries for hundreds and rarely thousands of lines. So it's important to use Excel where you can automatically check that your entry balances. Software programs often allow you to upload the journal entries, so it won't have to be manually keyed into the system. We'll now record the journal entries for Eli's consulting step by step. For the first transaction, Trayton Eli obtained the funds to start the business by withdrawing $100,000 from his personal savings account. To start the journal entry, leave a blank line between general journal entries. Some accountants use this blank line to number each general journal entry. When possible, the journal entry description should refer to the source of information. For example, the journal entry to record a payment should include the check number in the description. Accountants use journal entry numbers to identify journal entries. Document numbers are part of the audit trail. What is the audit trail? The audit trail is a chain of references that makes it possible to trace information, locate errors, and prevent fraud. The audit trail provides a means of checking the journal entry against the original data on the documents. Documentation is critical. The external auditors will want to review the supporting documentation at year-end. However, sometimes the supporting documentation is confidential. For instance, severance amounts when there are company layoffs. In those cases, the journal entry will reference the person or department that can provide documentation upon request. The supporting documentation for the $100,000 contribution is a memorandum from Trayton Eli to Sergio Sanchez. Additional documentation might be the deposit into the business bank account and legal documentation that shows Trayton Eli gave Eli's Consulting $100,000. As an accountant, it is important for you to be able to substantiate or prove that you recorded the journal entry correctly. That proof would be the documentation. Many accounting systems let you attach the documentation to the journal entry, so it is always available if there is a question as to why the journal entry was recorded. To record this business transaction, we debit cash for $100,000 because cash is an asset and assets increase with debits. And we credit the capital account for $100,000 because capital is part of owner's equity and owner's equity increases with credits. November 7th, Eli's Consulting Services issued check 1001 for $5,000 to purchase a computer and other equipment. We can see the journal entry documentation, but in a real company, this support would not be sufficient because it does not provide the details of the purchase, model number, specs, and so on, and evidence that Eli's Consulting paid the information technology store. This document looks like it's a check stub from a checkbook. The necessary documentation in this case should be a copy of the invoice from the information technology store. The invoice should detail the items that were purchased and should show Eli's Consulting Services as the purchaser. Accountants are responsible for verifying proper documentation before recording any entries. So for this transaction, we debit equipment and credit cash for $5,000 once the proper documentation has been received. November 10th, Eli's Consulting Services purchased office equipment on account for $6,000, and we have the invoice here from Office Plus. The invoice shows the invoice number, the date, order number, shipping and payment terms, and the name of the buyer, and item details of what was purchased. This invoice shows the right level of support. Please note that many businesses do not record assets for equipment and supplies that cost less than a certain amount, like calculators. The threshold depends on the size of the business. The accountant should ensure accuracy of the invoice and the payment terms as well as the proper purchase order number. In addition, the accountant needs to ensure that the correct sales tax is calculated. So for this transaction, we debit equipment and credit accounts payable for $6,000. November 28th, Eli's Consulting Services purchased supplies for $1,500, check 1002. Again, this is not proper documentation. We don't even have an invoice. In fact, we don't even know if supplies were purchased. We also don't have a copy of the check. This would not pass an audit, and I would be concerned if a business owner provided this as a receipt. During an audit, the auditor would ask for the invoice from Office Deluxe, a copy of the canceled check, or other proof that the amount was paid. In some cases, the auditor might even ask for verification from Office Deluxe directly. For this business transaction, we debit supplies for $1,500 and credit cash for $1,500. Why? Well, our supplies assets increased, and assets increase with debits, and our cash decreased. Cash is also an asset, and assets decrease with credits. For our fifth transaction, Eli's Consulting Services paid Office Plus $2,500 in partial payment of invoice 2223, check 1003. In this case, we have the original invoice from Office Plus for $6,000, which would serve as support, but we would also need a copy of the check, or the Zelle or Venmo payment record would be good additional support. The auditor might even ask for verification from Office Deluxe directly. For this business transaction, we debit accounts payable for $2,500 and we credit cash for $2,500. Why? Well, our accounts payable decreased, and accounts payables are liabilities which increase with credits and decrease with debits. We credit cash because it is an asset, and it decreased, and assets decreased with credits. Next, for our sixth transaction, Eli's Consulting Services wrote check 1004 for $8,000 to prepay rent for December and January. Again, this is not proper documentation. In this case, I would like to see the rental agreement and a copy of the check or other payment remittance. For this business transaction, we debit prepaid rent for $8,000 and credit cash for $8,000. These next 6 business transactions and journal entries are for revenue, expenses, and a withdrawal transaction. For the 7th transaction, Eli's Consulting performed services for $36,000 in cash, which means that we need to increase cash, which we do with a debit of $36,000. Our fees income also increased, and revenue increases with credits. Therefore, we record a credit to fees income. For the 8th transaction, Eli's Consulting performed services for $11,000 on credit, which means that we need to increase accounts receivable, which we do with a debit of $11,000. And our fees income also increased, and revenue increases with credits. Therefore, we'll record a credit to fees income of $11,000. Revenue transactions should be supported by invoices and potentially a contract between the client and Eli's Consulting. So next, for our 9th transaction, we received $6,000 cash from credit clients who previously received services on credit. In this case, we'll debit cash because our assets increased, and we'll reduce accounts receivable with a credit of $6,000. For the 10th transaction, we paid $8,000 in salaries and need to increase our expenses by debiting salaries expense for $8,000 and reducing our cash with a credit of $8,000. The supporting documentation for salaries and wages is the payroll register. For the 11th transaction is very similar, but we debit utilities expenses and credit cash, and the support for the utilities expense is the utility bill. For the last transaction, we need to debit the drawing account and credit cash for $5,000. For Trayton Eli's withdrawal, I would want to see a document signed by Trayton and acknowledging that he received $5,000. Some transactions consist of more than one debit and one credit and require compound entry. So for instance, on November 7th, the firm purchased equipment for $5,000, issued check 1001 for $2,500, and agreed to pay the balance in 30 days. The journal entry debits equipment for $5,000 and then credits cash for $2,500 and credits accounts payable for $2,500. Now, our second example, the firm purchased office equipment for $2,000 and office supplies for $500 with check 1002 on December 14th. For this business transaction, we would debit office equipment for $2,000 and debit office supplies for $500 and credit cash for $2,500.